I see Sal has a question in the chat here. Joe, walk me through your cost basis discipline. How do you determine what not to buy when debt is cheap and cap rates are compressing, especially during the pandemic frenzy?
That's an interesting question. Walk me through your cost basis discipline. Is that what it said?
Yep. How do you determine what not to buy when debt is cheap and cap rates are compressing?
How do you determine what not to buy when debt is cheap and cap rates are compressing? I don't know that that's a hat I put on when I'm looking at a facility. We're looking at first and foremost the market, not even so much the cap rate or interest rate environment we're in, because while there was a period in 23 where interest rates went up 400 basis points in 6 months, that was an interesting time in terms of buying deals, understanding the fundamentals of the deal, but also then having to worry about the environment we're in. That's a great question for that environment. But for the most part, the interest rate or environment I'm in should not, in my opinion, affect whether or not we're buying a good deal, because I don't model, for instance, a 7 cap purchase and a 6 cap exit. If anything, I'm modeling a 7 cap purchase and a 7.5 cap exit. So really, it comes down
Mm,
to what's the market I'm in? Do I want to be there today and do I want to be there tomorrow? Can I add value to that facility? And that doesn't mean physically. It could be that's back to the mom and pop management scenario. Are they well below market rates? Are they doing anything from a marketing standpoint? Are they with the times in terms of management? Can we add value in that regard? What we didn't do, maybe this will answer that question. I never even had that hat on because I don't even consider that. But what we didn't do was buy facilities just because we were in a low interest rate environment. I know a lot of folks did that and they're probably feeling that pain today. We actually bought some facilities in that environment based on the fundamentals. And because it was post COVID, you could argue everybody overpaid for every facility if you're playing Monday morning quarterback. You had inflated trailing 12s when we buy everything based on trailing 12. But even then, if you step with your principles in terms of buying it, you felt pain for the last 2 years, no doubt. And you really had to learn and make sure you operated these things very well. We're coming out of that now. But yeah, a lot of people that didn't do that, you're seeing those hit the market today. And they're good facilities. Some of them were even built during that time with floating rate debt, super cheap debt, floating rate debt. You're now seeing them hit the market, not even stabilized, and probably at what it costs to build them, if they're lucky. And they'll probably be lucky to get it. I don't know if I answered specifically the question, but I don't think I wore that hat or I wear that hat when I look at a facility. We're looking at too many other factors, and I'm not making aggressive assumptions on interest rates or cap rates when we buy.
that's excellent. Yeah. I- And I heard that in the self-storage space right now, a lot of people are not able to fill the spaces. Are you seeing that in the markets that you're in? What is the sentiment in the self-storage space right now in terms of occupancy rate and things like that?
That's always an interesting question. Depending on the genesis of the question, we see national statistics, and then I get a question based on that. And that might be true nationally. However, storage is local. It's a 1, 3, and 5 mile business or 10, 15-minute drive time if you start to get a little more rural. People ask me all the time, is Atlanta a good market? Or pick a city. Is X city a good market for storage? And I say, I'll find you 10 submarkets where it is and 10 where it isn't. It's really that local. As across the board nationally, just to jump back to that, what COVID gaveth, COVID tooketh away. During COVID, we had record high occupancies across the board, didn't matter. In fact, it was hard to buy even during COVID because you'd make even a full price offer and the broker wouldn't return to you if it was a listed deal because people were just trading. They were speculating on what was going on during COVID and that it would last forever. Post COVID, tough sledding. People went back to work. They moved out of storage facilities, brought the stuff back into the home office or back into the garage or whatever it was. And really, what we felt, and this might be the first time since they've been measuring, keeping good data and statistics and storage. It hasn't been that long. It's only been like 25 or so years since they've really been keeping some pretty good data on it. But I think for the first time, we had a measurable event that was bad, that we all realized how reliant storage is on not the real estate market from a value standpoint, but from a transaction volume standpoint. So
Mm.
for the last 2 years, residential real estate transactions were way down, probably because of the interest rate environment, but also because we had a pretty stagnant economy as well. So you had not exactly enticing interest rates for home buyers and a tough economic environment for them as well. I don't know if it was a recession or not. I think depending on your political stance and who was in office, it was a recession or not a recession, or now it's a recession, or then was, I can't keep up with that. What I do know is it was a tough economic environment the last 2 years, and the real estate transactions were down. And for that reason, that question is on point. Yes, our occupancies across the board went down, and it was tough sledding out there. And I would say that was nationally, with the exception of some local markets, but nationally, that was the case. And we saw that across our portfolio. Post COVID is probably when we managed the most. We probably were managing 14, 15, 16 at one time. And I would say most of them, our occupancies were below where we wanted them to be. But we did have examples where some were still stabilized and really outperforming everywhere else. And that was unique to storage being local, because it is. I think we did fairly well because of our main thesis, which is market. Market is the most important factor for us. And the two most important factors in the market are population trends and supply index. So we want to be where people are moving to, not moving from, which is why if you looked at where we bought, we're mostly Southeast. Now we're East Coast based. So if I was West Coast based, I would probably be mostly Southwest, right? Because populations are going Southwest and Southeast for the most part. Although I think we're seeing a rebound in the Midwest, probably because of manufacturing and trades, but that's an area that we're watching and very bullish on, actually. So yeah, for the most part, storage tail end of 23, all of 24, and the beginning of 25 is where we started to see the rebound, where now most of our facilities are actually stabilized. And because we spent so much time really grinding on the operations, or what I call the kitchen, I think we're actually exceeding our occupancy targets almost across the board. Even the facilities where we struggled on, like majorly struggled on, which is only 3 or 4 out of the 20, our occupancies are way up there.